So picture this. It's like 11 p.m. on a Tuesday, you're lying in bed, you can't sleep, and you're scrolling through your phone. And somewhere between a meme and a news article, you see it. Some post about a guy who turned $5,000 into $500,000 in 8 months trading crypto, and you just stare at it. You read it twice, maybe 3 times, and something in your chest does this weird thing. Part excitement, part anxiety, part something that feels almost like shame. Like, why isn't that me? And then your brain starts doing the math. Not serious math, the dangerous kind. The kind where you think, okay, if I put in $2,000 and it does even a fraction of what this guy's did, and before you know it, you're Googling best crypto to buy right now at midnight, and you've got 17 tabs open, and one of them is a Reddit thread from 2021 where somebody's talking about some coin you've never heard of like it's going to change the world. That feeling, that 11 p.m. spiral, I know it. I've been in it. And honestly, most of the people I talk to about money have been in some version of it too. My name is Emmy, and I spend probably too much time thinking about money, not just the numbers, but the psychology of it, the emotions behind it, why some people seem to build wealth almost quietly and steadily, while others keep chasing these big, explosive moments and somehow end up further behind than when they started. That gap between those two types of people, that's what keeps me up at night, probably more than it should. And today, I want to talk about something that I think is one of the most misunderstood financial traps of our generation. Not because crypto itself is evil, I'm not here to tell you that, but because there is a very specific way that the middle class engages with crypto that is almost perfectly designed to keep them from building real, lasting wealth. And most people don't see it because the trap doesn't look like a trap. It looks like an opportunity, a big, shiny, life-changing opportunity. And that's exactly what makes it so dangerous. By the end of this, I want you to understand not just what the trap is, but why it works so well, who it works on, and what you can actually do to protect yourself and build something real. Because the goal isn't to scare you away from anything. The goal is to make sure that whatever you do with your money, you're doing it with your eyes open. That matters more than any coin, any chart, or any Reddit thread. Let's get into it. So first, I think we need to talk about why crypto is so irresistible to the middle class specifically, because this isn't random. The appeal of crypto doesn't hit every income level the same way, and understanding why it hits so hard for people in the middle, not the very poor, not the very wealthy, but that big, wide middle, is really the foundation of everything else we're going to talk about. Here's the thing about being middle class that nobody really says out loud. You're doing okay, you're not in crisis mode, you're not worried about where your next meal is coming from, but you're also not free. You've got the mortgage or the rent that keeps creeping up. You've got the car payment, the insurance, the kids' school stuff, the emergency fund that never quite gets to where it's supposed to be. You're working a real job, probably a good one, but you look at your bank account at the end of the month and the number is just never as impressive as you feel like it should be given how hard you're working. And the really painful part, you know the math. You've read the articles. You know that if you just invest consistently, if you just put money in index funds and wait 30 years, you'll be fine. But 30 years feels like a lifetime, and fine doesn't feel like enough, because you can see the life you want, the financial freedom, the breathing room, the ability to say yes to things without calculating whether you can afford it, and it's close enough to feel real, but far enough that the normal path feels too slow. That's the emotional environment that crypto walks into, and it couldn't be more perfectly calibrated for exactly that psychological state. Because crypto doesn't say wait 30 years. Crypto says this week. crypto shows you real people, not fictional characters, not hypotheticals, real people with screenshots and portfolios and life-changing stories who did it fast. And your brain, which is wired to respond to stories way more than statistics, grabs onto those stories and runs with them. And suddenly the boring, sensible path feels even more boring by comparison, which is not great for your decision-making. Now, here's where the first real trap lives, and I want you to stay with me on this because it's a little subtle. The trap isn't that people invest in crypto. The trap is why they invest in crypto, and more importantly, when. Think about the typical middle-class crypto story. It doesn't start in a calm, rational moment. It doesn't start with a spreadsheet and a long-term plan. It starts with a bull run. It starts when Bitcoin is on the news, when your cousin is texting you about how much money he made, when every other conversation at work is about some coin you've never heard of like it's going to change the world. It starts when prices are already high, when the excitement is already at a fever pitch, when everyone is talking about how this time is different. And at that moment, people don't buy crypto because of conviction, they buy it because of fear. Specifically, the fear of missing out, FOMO, which is one of the most powerful and most financially destructive emotions a human being can experience. FOMO doesn't feel like fear. That's the tricky part. It feels like urgency. It feels like clarity. It feels like finally being smart enough to see what everyone else is seeing. But it's fear. Fear of being left behind. Fear of watching other people get rich while you stay stuck. And that fear drives people to buy at the worst possible time, near the top, when everyone is excited, when the price has already done most of its moving. And then when the inevitable correction comes, and it always comes, they're sitting on losses, watching that number go down every day, feeling panicked, feeling stupid, and they do one of two things. They either sell at the bottom and lock in that loss, or they hold on and watch it drop even further and deeper, praying for a recovery that might take years. Meanwhile, that money they put in, that was their emergency fund, their house down payment, their just-in-case money. And now it's doing something very different than they imagined at 11 p.m. on that Tuesday. I'm not making this up. This is a pattern that has played out over and over, 2017, 2021, and every mini cycle in between. And the people who get caught in it aren't dumb. They're not reckless gamblers. They're regular, intelligent, hard-working people who just got hit by a very powerful set of psychological triggers at exactly the wrong moment.
Let me talk about something I think about a lot, which is the difference between speculation and investment, because I think this distinction has basically been lost in the crypto conversation, and that loss is costing people real money. When you invest in something, you have some basis for believing it will be worth more in the future. Could be earnings, could be growth, could be a product people actually use and need. The value is attached to something tangible. The timeline might be long, but there's a story you can tell yourself, a logical, grounded story about why this thing should be worth more 10 years from now. Speculation is different. Speculation is essentially a bet that someone else will pay more for this thing than you did. That's it. The thing doesn't have to earn anything, produce anything, or solve anything. You just need enough other people to believe the price will go up. And in that environment, the most important skill isn't financial analysis, it's reading the crowd. It's understanding hype cycles. It's knowing when to get out before everyone else does. And honestly, most people are not good at that. The people who are good at it, the professional traders, the hedge funds, the algorithmic systems, they are very literally on the other side of your trades. You are not competing with other confused retail investors. You are competing with professionals whose entire job is to take money from people who are guessing. This doesn't mean there's zero place for speculative assets, but calling speculation investment is how people trick themselves into taking risks they wouldn't otherwise take. Because investment sounds responsible. Investment sounds like something you're supposed to do. And if you've convinced yourself you're investing in crypto, it's a lot easier to put in money you can't afford to lose. Okay, so here's something that I find genuinely fascinating and a little infuriating, which is how the crypto ecosystem has basically built an entire culture designed to keep you in. And this isn't a conspiracy theory, it's just good business for the people building it. Think about the language: hodl, diamond hands, weak hands, to the moon. These aren't just fun memes, they're psychological anchors. Diamond hands sounds like strength and conviction, but it functionally means don't sell no matter what happens. And weak hands is basically a social punishment for the rational instinct to protect yourself when something is going wrong. If you sell during a crash, you don't just lose money. Within that community, you lose identity. You're a coward. You're the person who didn't believe. And for a lot of people, especially people who are really embedded in that community, that social cost feels worse than the financial one. This is genuinely sophisticated psychological engineering. It turns a basic financial decision, should I exit this position, into a question of character and belonging. And when you make it about character, you make it almost impossible to think clearly. Because now you're asking, is this a good investment? You're asking, am I a good person? Am I brave? Do I belong here? And those questions lead you to hold a coin that's dropping every single day, telling yourself you're a believer, you have conviction, you see what others don't. Meanwhile, the people who actually started these projects or got in very early often have no such emotional attachment. They're selling into your conviction. Your diamond hands are their exit liquidity. And that phrase, exit liquidity, is one of the most honest things you'll ever hear in the crypto space, if you're listening carefully enough. Let me talk about the wealth gap this creates, because this is maybe the most painful part of the whole picture. Here's what actually happens in a crypto bull market. The people who benefit most are, in order, the founders and early investors of the projects, the large institutional holders who bought in early at low prices, the professional traders who know how to move in and out at the right moments, and then way down at the bottom of that list, the retail investors who piled in when the price was already high. Who is that last group? Disproportionately, it's middle-class people who saw an opportunity, felt that FOMO, scraped together their savings, and got in right before the music stopped. So in a very real sense, crypto bull markets have been, and I want to be careful here because this isn't about blaming anyone, they've been a mechanism for transferring wealth from the middle class to people who were already wealthy enough to get in early and sophisticated enough to get out in time. Not always, not for everyone, there are genuine middle-class success stories, but as a pattern, as a structural thing, this is what the data shows. And it's the opposite of the egalitarian financial revolution that the crypto narrative promises. The rich get richer. The middle class gets a story to tell about the time they almost made it, and then they go back to work on Monday. Now I want to spend a little time on something that I think is genuinely underappreciated, which is the opportunity cost of all of this. Because even when people don't lose everything in crypto, even when they just sort of break even or make a small amount, there's still a cost that doesn't show up in their portfolio number, and that cost is enormous. Let's say you spent 18 months obsessively following crypto prices, checking your portfolio 5 times a day, watching YouTube videos about which coin is about to explode, staying up late, getting that chronic low-level anxiety about what Bitcoin is doing. Let's say at the end of it, you made a little money or broke even. Sounds okay, right? But what could have been happening in that same 18 months? You could have been building a skill that increases your income. You could have been building a side business. You could have been developing relationships that open professional doors. You could have been investing consistently, automatically, in boring, diversified funds that quietly compound. You could have been learning something that makes you more valuable at work. All of those things build on each other. All of those things compound in ways that are slow, but real and durable. The mental energy you spend obsessing over a speculative asset is mental energy you're not spending on those things. And when we talk about why the middle class struggles to build wealth, I think this, the invisible drain of speculative obsession, is one of the most underrated factors. You can't see it on a spreadsheet, but it's real.
All right, so I don't want this to just be a takedown, because honestly, that would be kind of unfair and also not very useful. The point isn't crypto bad, run away. The point is that there is a specific relationship with crypto, a desperate, FOMO-driven, savings-depleting, community-reinforced, all-in relationship that is genuinely harmful to middle-class wealth building. And there's a different relationship with it that's much more defensible. So let me talk about what that actually looks like in practice. The first thing is something that sounds almost too simple, but it's foundational. Get your financial basics in order before you speculate with anything. That means an emergency fund, actual cash sitting somewhere boring, not in a coin that could drop 60% next month. It means you're not carrying high-interest debt. It means you have some kind of consistent investment going into boring, diversified, long-term things. Once that foundation is solid, once you have that boring infrastructure working for you, then and only then does it make sense to put any money into something speculative. And the second thing is the sizing question. The question isn't, should I buy crypto? It's how much of my portfolio makes sense here. And for most middle-class people, if the answer is more than 5 to 10% of their investable assets, that should probably give you pause. Not because the number is magic, but because the right size for a speculative bet is one where if it goes to zero, not drops, goes to zero, your life doesn't materially change. If losing that money would hurt you, that money is too important to speculate with. And the third thing is something about motivation. And I know this sounds soft, but I promise it matters. Ask yourself honestly, am I doing this because I've thought carefully about this technology and I believe in its long-term potential? Or am I doing this because I saw a screenshot and I'm afraid of missing out? Because those two things will lead you to make completely different decisions when the price starts dropping. Conviction holds, FOMO panics, and the markets are very, very good at finding out which one you have. There's one more thing I want to touch on, and it's a little bigger picture than everything we've talked about so far. I want to talk about why this trap exists in the first place. Like, structurally, why does our society produce so many people who are vulnerable to it? And I think the honest answer is that the normal paths to wealth accumulation have genuinely gotten harder. Home ownership is more expensive relative to income than it was a generation ago. Wages have not kept up with asset prices. The return on just working hard and saving diligently is lower than it was for our parents. So people aren't wrong to feel like they need something more. They're not wrong to feel like the conventional path is leaving them behind. That feeling is grounded in something real. But the answer to a real problem doesn't have to be the right answer. In crypto, as it's typically experienced by middle-class retail investors, is not the answer to that real problem. It's a very sophisticated product, and I do think it functions as a product, even if that's not how it's framed, that captures the real frustration and anxiety of people who feel financially stuck and redirects that energy into something that historically benefits the already wealthy at the expense of the people who could least afford the losses. That's not destiny, that's not inevitable, but you have to see it to protect yourself from it. So where does all of this leave us? What's the actual takeaway after all of this? I think it's this. The middle class doesn't stay stuck because they're not smart enough or disciplined enough or because they don't want it badly enough. A lot of the time, they stay stuck because they're playing a game that's stacked against them, using rules that seem empowering but aren't, chasing returns that are real for some people, but mostly not for the people who chase them the loudest. And the crypto trap is a particularly elegant version of that dynamic because it wraps itself in the language of freedom and revolution and empowerment while doing something very different in practice. And look, I know this is maybe not what you wanted to hear if you came into this already excited about crypto. That's okay. I'm not telling you what to do with your money. I'm not here to be your financial advisor or your conscience or your mom. But I do think you deserve to see the full picture. Not the highlight reel, not the success stories, not the hype. The actual structural reality of who wins and who loses in these markets and why. Because here's the thing. You are not behind. You are not too late to build something real. The boring path, the consistent investing, the skills building, the patience, is not a consolation prize. It's the actual prize. It just doesn't make for a good 11 p.m. screenshot. It doesn't give you a story to tell your friends next week. It works slowly and quietly, and then one day it works dramatically. And unlike a lot of the alternatives, it mostly keeps working. I want that for you. Not because I know you, but because I know this stuff matters. Financial stress is real. Financial stagnation is real. And the difference between people who break out of it and people who don't is rarely about luck or timing or getting into the right coin. It's about understanding how money moves, who it moves toward, and building the kind of slow, steady, boring foundation that lets you sleep well on a Tuesday night instead of spiraling through 17 tabs. That's what I want for you, genuinely. And I think if you made it this far, you probably want it too. Take care of yourself out there. And maybe close a few of those tabs.